Does the 4% rule work in today's markets? My man Wade Pfau, we're going to read a couple articles from Wade here pretty quick, but it's good stuff. And I'm a big fan of Wade and retirementresearcher.com. Do we have a dateline on this? I don't see it, but it's from an email I got just about a month and a half ago or so. So, all right, so this is a match. So let's go to Wade. And again, retirementresearcher.com. I interviewed Wade for the podcast a couple months ago, and I'm just a fan of these guys. So, does the 4% still work? 4% rule still work? This is a matter where Monte Carlo simulations are able to shine by allowing simulations to begin from today's starting point rather than incorporating historical outcomes generated from completely different market environments. Let's consider outcomes for sustaining spending rates using the Monte Carlo simulations with a low interest rate world as of today. We will not make any adjustments to reflect the high stock market valuation, but we will preserve the historical equity premium that stocks have earned above bonds. So again, this is where the Dow 30,000 from James Glassman, back, I guess he had written that in 98, 99, something like that. It's similar to an Irving Fisher thing where he had written it and published it right when the market was at its peak and then proceeded to get killed and everyone made fun of him. But he was right on. He goes, the equity premium, how much more you get over bonds over time, would show you that the Dow will hit 30,000. And lo and behold, as much as belated as it is, we're at 27,000 now. So he's right, because the equity market gives you a premium over bonds because the equities have more risk. That's just reality. Now, does that mean it'll happen going forward? No, I have no idea. But historically, that has proven true. And thus, we go back to Jeremy Siegel's stocks for the long run. If bonds give you 2, stocks give you 5, that's an equity premium of 3% a year. Can you bank that on any given year? No. Should you expect that going forward? Yes. But it's not guaranteed. All right, so when bond yields are low, stock returns must be less as well, as there is no particular reason that stocks would offer even higher premiums above bonds than they have done in the past. So again, going back to the equity premium, about 5%, I think. We got bonds at 6, stocks at bonds at 5, stocks at 10. I think we have a 5% equity premium, 4 or 5, we'll just say. On average, these simulate, and so going back, so if you have bond yields at 2, then your equity premium would be 6. Your equity return would be 6. That makes sense. So Wade is just saying, look, we aren't going to have low bond rates at 2 and high stock returns. We're going to have low bond rates at 2 and the equity premium historically of 4 or 5%. I actually think that's a great scenario. I'm a big fan of that because I think the equity premium will persist. But I think it will persist relative to the bond yields for sure. I hope that makes sense, because the idea that all of a sudden now, I guess you could make an argument that with the low bond yields, there'll be more money going to stocks because people say, I can't get by on 2%. A lot of that money's fleeting, though. And so the equity premium might be good, but it'd be good for short term, I would say, simply because the minute the markets fall or go south, that money will be pulled back into bonds. So I would suggest that the equity premium would remain true at the low yield environment or the average environment, roughly 4 or 5% above bonds. All right. On average, these simulations allow bond yields and therefore stock and bond returns to wander upward towards historical averages over time to reflect the unlikelihood that interest rates would remain low for the next 30 years or longer. We don't know. I would say it's not that unlikely. But interest rates could remain low, and some simulations account for this. Exhibit 1 provides a way to compare the success for the 4% rule using Monte Carlo simulations that reduce bond yields at the start of retirement. This is compared with simulations calibrated historical averages, as well as results of a rolling period of historical simulations. The exhibit makes clear that the low interest rate environment creates additional stresses for the 4% rule that were not apparent in Monte Carlo simulations with historical data with higher bond assumptions than are available today. For a 50-50 asset allocation stock to bond, these simulations indicate that the 4% rule has a 69% chance of success as opposed to 94% chance under the historical norms. The 4% rule may work for today's retirees, but is far from a safe bet. And I agree with that. With lower stock allocations, the 4% rule is less likely to work because it's placing demands on spending above what today's interest rates can easily support. It is magical thinking to believe that bonds can earn higher rates of return than implied by today's low interest rates environments. And spot on. Let me just repeat that. It is magical thinking to believe that bonds can earn higher rate of return than implied by today's lower interest rate environment. For all you back there saying, I got 12% of my bonds year to date, it's magical to think that will continue on. It's not. It's all reverts to the mean when it comes to bonds. Returning to the issue of sequence of return risk for retirees, the earlier returns matter disproportionately in determining sustainable spending outcomes. Success is also less for higher stock allocations because of the assumptions that the historical equity premium is maintained on top of a lower bond. Success is also less for higher stock allocations because of the assumption that the historical equity premium is maintained on top of a lower bond yield for the early part of retirement. All right, so here we go. Rolling historical summaries. Monte Carlo is going to be the gray. The blue will be rolling historical. The gray will be Monte Carlo simulations with historical averages, and the green or turquoise, is that what it's called? Turquoise will be the Monte Carlo starting with low yields. All right, so you can see, and this is stock allocation from left to right, 0 to 100%. And here we are, 100% stocks with the low yields are 78% using a 4% rule with low yields but same equity premium. So for 30 years, if you had 100% in stocks, you'd have a 78% chance of outliving your money. I mean, your money outliving you, which is good. Historically, 100% stocks, you have an 89% chance using historical Monte Carlo simulations, and you're using rolling historical averages, you would have a 93%. And this would be our, that would be kind of our intermediate, where we're shooting for 100% rolling period. If you had 60% stocks, 100%. If you had 30%, so if you had 40 to 60% stocks, 40 to 70% stocks, historically, you would have not run out of money in historical norms, rolling periods. If you had 40 to 70% stocks, you would have not run out of money less than 10% of the time. You would have run out of money less than 10% of the time. But with the current model, you never get above 80% success. And you can see the more attributed to stocks, the better off you do. But of course, that means more risk. Exhibit 2 provides further details by plotting failure rates instead of success rates. I like that. For different withdrawal rates and asset allocations using the same Monte Carlo simulations. Failure for a 3% withdrawal rate hovers about 10% for stock allocations between 40 and 100%. This suggests that in a lower interest rate world, a 3% withdrawal rate reflects something closer to the chance of success than a 4% withdrawal rate historically would have done. In addition, when spending rises above what the bond yield curve is able to support, bond allocation will lock in failure. And I 100% agree. This explains why the 100% stock allocation support the lowest failure when spending rates are above 4% or more. It's just because if you have a low bond yield and you're spending more than the bond yield, inherently you're eating into your principal the more bonds you have. And so what he says is withdrawal rate of 3%. So we got stock allocation 50% here, withdrawal rate of 3%. You had a 90% success rate. All right, that's good. So, he can see basically from 50 to 90, basically from 40 to 100, you're sitting pretty without question. Withdrawal rate of 4% here from probability of failure is if 40% stocks, you had a 40% probability of failure. That's not good. 60% stocks, you had a 28% probability of failure just at a 4% rate of withdrawal rate adjusted for inflation. All right, here's a withdrawal rate of 5% because I always talk about the 5%. I like the 5% rule, and I'll share with you why here in a future video. But you had a 60% withdrawal. If you have a 5% withdrawal rate and 50% stocks, you got a 60% probability of failure. But if you have 80% stocks, you still have a 42% probability of failure. So that's not going to get the job done for anybody. So you got to be careful. These guys, a couple articles, challenges the 4% rule, sustainable spending, and the 4% rule. So what I'll do is I'll do this other video. I'll do another video on the difference between safe and optimal withdrawal rates. I'll do that next because I think it's actually incredibly important to understand that. So let's just look back at this here real quick. The rolling period, look, man, here's the issue. Remember, the 4% rule assumes your spending increases each and every year with inflation. That's why I discounted. Not that I don't discount the 4% rule and Bill Bengen. I discounted that you're going to spend each and every year an increasing amount of money as you get older, adjusted for inflation. The evidence says screams the opposite, as a matter of fact. That you'll adjust it for inflation, but your actual consumption will go down because you're older. That's all there is to it. Will that be you? I don't know. But most people, according to the BLS Consumer Expenditure Survey, HRS, University of Michigan, and then another one, I forgot the other one too. It's not Census Bureau. Anyway, the studies show that overwhelmingly that most people, as they age, their actual consumption goes down, even when you adjust it for inflation. All right, stay tuned. I'll do this next video here in just a second.